Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at three soaring value stocks that also have a high Zacks rank to consider buying in April. And those three stocks are Paccar, which trades in the ticker PCAR, Murphy USA, which trades ticker MUSA, and then DaVita Inc., which trades in the ticker DVA. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look in some of our services, portfolios, and more. So before we jump into these three stocks, I want to do just a quick market recap, just to give a sense of what's going on in the broader market and why you might want to consider these three stocks. So the S&P 500 and the NASDAQ edged out small midweek gains, and then to stop some of the early bleeding to start the second quarter. And then as I'm recording this on early Thursday afternoon, the S&P 500 was up about 0.8%, and the NASDAQ was up about 1.1%. So we're bouncing back after those early losses to start the second quarter. The benchmark and the tech-heavy index once again found support at that 21-day moving average. It's kind of been the line in the sand for the bulls since early December, and there's been seemingly regular scheduled pullbacks to that level, followed by a run back up to new highs, preventing the market from really overheating. Wall Street, as always, earlier this week was a little bit focused on what Powell had to say. He continues to toe what has become kind of his party line of we're going to remain data dependent, and we're not going to declare victory over inflation. He probably will never declare victory over inflation, even when they do start to lower interest rates. But despite what Powell has said, Wall Street is still convinced that the Fed is going to cut rates at some point in 2024. They currently have the odds of about 67% that there will be a cut in June or July, with nearly 100% certainty that they're going to cut at one point in 2024. That said, though, the Wall Street is pricing in higher for longer, so the 10-year is up near fresh year-to-date highs of around 4.35%, which is well above the where it was right after Christmas, which was about 3.78%. We're still, though, way below those highs of about 5% in October, when the market last bottomed. So that gives a sense of where we are at the moment. So the next big market movers will likely be the start of first quarter earnings season, which starts on April 12th with some of the big banks, and then we kind of roll into the heart of it all in the coming weeks. Overall, though, it's worth noting, I want to just point this out. So after the strong start we had over the last 5 months, so the dating back to November, my colleague Brian Hayes pointed out last week that if how bullish of an indicator this is. He's really great with longer term market trends and historic events that might repeat themselves. So he noted that from when we look at similar stretches through history, when the S&P 500 advances 5 months in a row from November through March, forward returns appear quite enticing, spanning 11 instances dating back to 1950. The index has never been lower through the remainder of the year, and the median return for the last 9 months of the year after a situation like that has been 11.2%. So that's overall really bullish. We could at some point likely have a larger pullback to, say, the 50-day or the 21-week moving average. You never know, but the overall bullish background seems to remain pretty strong, especially if first quarter earnings results and guidance come in solid. So with that in mind, we're going to take a look at the first of these three stocks, and that is Paccar, which trades in the ticker PCAR. So it is one of the largest manufacturers of heavy-duty trucks in the world, and it has substantial manufacturing exposure to light and medium trucks as well. It designs and manufactures diesel engines and powertrains and components that are used to produce the sale of third-party manufacturers as well for trucks and buses. Besides supplying aftermarket parts, it also offers financing and leasing services. Some of its well-known brands include Kenworth and Peterbilt and beyond. Overall, Paccar is in a dominant position in a key area of the economy, even though it might not be like the sexiest growth area. Trucks are kind of the lifeblood of the economy when you think about it, along with energy and things like that. Trucks help deliver about 75% of freight in America. Diesel powertrains are currently the go-to in terms of heavy-duty trucks and light and medium trucks as well. But they're also focused on they have been improving emissions immensely over the last decades with diesel powertrains. But Paccar and many others, but especially Paccar, is working on rolling out continuing to roll out diesel powertrains, but then also working on EVs and hydrogen fuel cells, and then even hydrogen combustion engines as well. So that's kind of a part of their longer term growth model alongside continuing their diesel powertrains. The company delivered a record number of vehicles worldwide in 2023 with about 204,000 or over 204,000. They also announced a joint venture with Cummins and some other companies to manufacture commercial vehicle batteries in the United States. And then one of their brands, which is DAF, opened a new electric truck assembly plant in the Netherlands. So they're focused on the here and now while also looking ahead to the future as well. The company's coming off a really strong 2023. It's actually coming off a really strong 3-year stretch of doing about 22% revenue growth last year, 23% growth the year before that, and 26% growth before that. So they're coming up against a really difficult to compete against stretch, but overall the outlook long term is really strong for Paccar. And we should note that its parts and its financing operations generate an increasing percentage of their overall profits to help reduce kind of the impact of these broader business cycles that a company like Paccar and other kind of heavy duty and industrial focused businesses experience. And overall, its earnings revisions outlook has been really impressive over the last several years, with the current its FY24 estimate is up 28% over the last year, and its 2025 estimates up 17% over the last year. So its earnings outlooks continues to improve. It currently lands a Zacks ranked number 2 buy based on those improving earnings outlook. And it's also its dividend is yielding about 0.9% at the moment, and it has a really stellar balance sheet. And with that 0.9% dividend yield, it's been growing its dividend. It's been raising it about 5%, 5.5% annualized over the last 5 years. And its payout ratio is really sustainable at only 11%. So tons of room for growth there in the long term as well. And then in terms of its stock price performance, it's up about 415% in the last 15 years. This blows away its sector's 90% climb during that stretch. This also includes 165% run in the last 5 years alone that nearly doubles the S&P 500. And Paccar is up a whopping 75% in the past year, including a 24% year-to-date climb. So on an impressive run. And at the moment, as I'm recording this, the stock is bouncing off its 21-day moving average along with the wider market. It was up about 1% as I record this on Thursday afternoon. So finding support at that key moving average that the market's been really paying attention to for a lot of stocks and the overall S&P 500 and the NASDAQ. And despite this strong run over the last 15 years and the last 5 and the last year, it trades at a 33% discount to its 10-year highs at 14.4 times forward 12-month earnings. It's also trading at a 33% discount to the S&P 500 and around 6% below its sector, despite a huge outperformance. So overall, Paccar is definitely worth considering as a longer-term play to help diversify your portfolio, as trucks are not going out of style anytime soon, and they're also preparing to adapt for a future that might, say, years, decades down the road, include less diesel engines. Now we're going to move over to Murphy USA, which changes the ticker MUSA. The company is a gas station powerhouse. This is their more technical terminology. They market refined products through a chain of retail stations, almost all of which, though, are located near Walmart stores. So that's kind of a nice combination where if people are going to Walmarts, they come to Murphy USA to get to their gas as well. So kind of one-stop shopping there. They're primarily located in the Southeast, the Southwest, and the Midwest of the United States. They serve approximately 1.6 million customers daily. They also own a dedicated line space on one of the major pipelines in the U.S. So the company has access to pipeline and products, distribution terminals, and other key competitive advantages to help keep their costs really low and fiercely competitive in what is a really competitive gas station marketplace. So that's great to know. Their discount pricing and the quick check acquisition over the last several years and others are kind of the reason why Murphy USA is doing so well. They also have a $1.5 billion share buyback program they're in the midst of. So then in terms of its stock price performance, the stock has skyrocketed 900% in the last decade, leaving the benchmark's 190% run in the dust and destroying the Zacks oil and energy sector, which is down at 14% over the last 10 years. And its shares are up 185% in the last 3 years. This tops its sector's 60% climb, and it's been driven by a 63% run in the last 12 months, which also blows away the Zacks oil and energy sector, which is up just 11% over that stretch. The company, though, is currently trading now below its 21-day moving average, so investors might want to wait for a little bit more of a pullback, maybe down to that 50-day moving average. As I'm recording this, it was down as well on Thursday afternoon, but the recent downturn has helped it go from rather heavily overbought RSI levels to below neutral. So investors might step back in sooner than later. That said, you might want to wait even until it tests its 21-week moving average at some point. But if you're a longer-term investor, you don't want to try necessarily to time things too precisely because that can hurt you in the long run. But overall, the stock is a pretty solid technical position, though. If you're a technical trader, you might want to look for some of these levels to watch out for. And valuation-wise, Murphy USA is trading at a right near its 10-year median and 35% below its highs over that stretch at 15.7 times forward 12-month earnings, which does mark a premium to the wider oil and energy market at about 10.5 times forward earnings. But the stock has crushed it over that period, so you're paying up for that growth as well. The company also pays a dividend and returns excess cash through buybacks, which we kind of mentioned up top. So overall, some strong points there as well. So looking ahead, we're calling for solid growth both this year and next on the top line, and we're calling for earnings growth as well on the bottom line. So we're calling for about 3.5% growth on the bottom line this year and then another 6% growth next year. And overall, its earnings estimate revisions have trended really heavily in the right direction to help it land a Zacks rank #1 strong buy at the moment, with its outlook for 2025 actually up 18% since its last report. So really positive signs there. And then overall, over the last year, its 2024 estimates up 46% in terms of its adjusted earnings outlook, and it's up 48% for 2025 over the last year. So really impressive upward revisions for those 2024 and 2025 earnings outlooks as part of a continued trend upward over the last really 5 years for Murphy USA. So impressive stuff for the stock, certainly worth considering, as I said, as part of a more diversified portfolio if you're trying to get outside of just maybe a tech-heavy portfolio at the moment, which has done so well over the last year. And then the last stock we're looking at is DaVita Inc., which trades in the ticker DVA. It is one of the top providers of dialysis services in the United States. The firm aims to serve patients suffering from chronic kidney disease and other ailments. It serves approximately 250,000 patients at around 3,000 outpatient dialysis centers, of which about 2,600 are located in the U.S., and they have locations in roughly a dozen countries worldwide, so expanding beyond the U.S. as well. Its services include outpatient dialysis services, hospital, inpatient dialysis service, and then other services as well. And it's worth noting that roughly 15% of U.S. adults are estimated to have chronic kidney disease, according to the CDC, where diabetes and high blood pressure are the leading causes of kidney failure. So those are all things that are going up in the United States. So as morbid as it sounds, DaVita is in a pretty important business in the U.S. and other places in the world. It's expanding its reach both inside and outside the U.S. And like many healthcare companies, it stands to benefit over the long haul from an aging population. The company crushed our bottom line estimates throughout 2023. And Zacks estimates are calling for its adjusted earnings to jump 9% in 2024 and then another 8% in 2025 on the back of roughly 4% revenue growth both years. And its adjusted earnings outlook has continued to improve over the last 6+ months to help it grab a Zacks rank #1 strong buy at the moment. And its outlook for the current quarter and next quarter are up big. And then its outlook for 2024 and 2025 are up about 9% and 5.5% respectively over the last month or so. So impressive growth there. And then, as I said, this is part of a longer term trend over the last 6 months that's seen its outlook on the bottom line really improve. And then in terms of its price performance, its shares have climbed 700% in the last 20 years to blow away the S&P 500, which is up about 380%. And this includes a 140% run during the last 5 years to also outpace the benchmark. And its stock has soared 50% over the last 6 months to help it finally break above its 2021 highs. And it did that back in March. The stock is trying to find support at that 21-day moving average. And a recent cool down has helped cool down the stock to where you might want to consider getting in, even though it might be a little overheated on a longer term time frame. But as we mentioned with Murphy USA, you don't want to necessarily, if you're a longer term investor, try to time things too precisely, because that can cause you to miss out in the long run. And then valuation wise, despite this climb to new all-time highs and its run over the last 20 and 10 years, it's trading at a 38% discount to its 10-year highs. And a roughly 40% discount to the Zacks medical sector at 14.3 times forward 12-month earnings. So another really strong value play that's soaring to new highs that might be worth considering at the moment. So all three of these stocks certainly worth digging into in April, especially as the market gets a little maybe overheated. These stocks, their prices are going up, but their valuations still look really, really solid. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.